everybody. This is Mining Stock Daily and your host, Trevor Hall. We have a little bit of a different presentation here. I have reached out to three highly respected CEOs out of the junior exploration and resource development industry here for a little bit of a CEO roundtable discussion. So what I'm hoping comes out of this is a little bit less questions from myself and more of an opportunity for these three individuals to really ask each other questions, talk about the markets, the industry, maybe some background experience and the like. So I'm happy to welcome Mr. Matt Manson, who is the CEO of Marathon Gold, Mr. Jeff Pontius, the CEO of Corvus Gold, and George Salamis, CEO of Integra Resources. Both Integra Resources and Corvus Gold are sponsors of Mining Stock Daily, and I am a happy shareholder of all three of these companies. So, gentlemen, thank you so much for taking some time out of your day.
Good morning.
Yeah, morning.
So, this idea of mine kind of spurred on in a little bit of background. So, I grew up in very rural Nebraska, farm country, and I remember as a kid, my dad on the weekends would wake up early and we'd get in the truck and go drive to some other farmer's house where there was coffee and donuts and breakfast going on. And for like what seemed like an eternity, but really was probably only an hour or two, the farmers would really sit around and talk shop, talk business. Obviously, there was a little bit of Nebraska football being discussed at the time, no matter what time of year. But really, it was a great opportunity to just kind of to hear the stories and hear what's going on with those operations. And so that's kind of the idea of what spurred this on. And I would like to have this conversation with all three of you about the first topic I had was what a difference a year makes. I mean, I remember a year ago, back last spring and late winter, it was tough going. The capital was really dried up. Money was hard to come by. Even with good drill results, share prices really were not moving hardly at all. So I thought if we can maybe just start off with that idea, and George, just start with you. If we take back a year ago, what has changed overall for Integra over this past year?
Oh, yeah, lots of changes. I mean, first off, the market is certainly far more buoyant now than it was this time last year. This time last year, we had just about to put out our new resource update, and that was a really big event for us because that marked a big transition of a lot of our inferred resources to an M&I category, and I think that caught the market by surprise, partially surprise to us. So that's different, and we've since gone on to do a PA, and that kind of all worked out. But I think the biggest factor in terms of change, for sure, is the market appetite for stories like ourselves and my colleagues here. The advanced stage explorer near-term developers seem to be getting a lot of love these days, and obviously the gold price helps on that basis. But that's the biggest change, certainly, that I've seen in the last few months.
Jeff, there's been quite a bit of change for you and the Motherlode project just within the last couple of weeks. But I mean, let's talk about a year ago. Like what has changed for Corvus?
Well, I think George is absolutely right. We have a tailwind right now of the market, and to me, there's enough gray hair sitting around on this call, I think, to remember back at the days when we had the 2007 to 2012 bull gold market, and I see a lot of similarities to what happened in that time. I had a company, ITH, at the time that was a similar kind of explorer developer, big project in Alaska, and we saw not only ITH but the sector as a whole move from the down to the bottom, sort of where we were, where it was sell everything, like we had back in February here, and then the group. And you can look at this group of companies as well, and they're a good indicator of that. Comes up about 50% in share price value, and liquidity increases, and we see volume increase. And that was the initial step that we saw for the recovery and actual outperformance of junior developers going forward. And I think it's critical that we as junior developers, continue pushing our project along the way and show the value of those projects. I mean, Marathon's a great example. They've got themselves a great project there that's moving along the path for development, further along than probably George's project or mine, but it really is kind of the secret sauce in my mind. It's what ITH had in the day when I remember the last bull gold market, and it really looks like we're in one now. So I think that's the key thing we have to provide for our shareholders, that vision or that path forward to really see where we're going on the next step and the next step after that. So and it's a great environment now. I mean, you can raise money. I mean, Matt just raised a nice chunk of money for his project, and I get calls from bankers like literally every day telling me about his deal and and how it was oversubscribed and the real interest levels there. So I think that's a great testament of the future ahead for us in this part of the sector.
Well, I do want to talk about the financing opportunities that are now available, and you have a conversation with the three of you about that. But Matt, let's turn it over to you. And looking back over a year, you're not even a year into your tenure there as CEO of Marathon. You came on, I believe, in the fall. I remember having a interview with you at the Beaver Creek Precious Metals Summit shortly after you took that position. So other than that, personally, what has this past year meant for Marathon?
Well, the last year has been, a lot of change for us on a company basis, and I personify part of that change. You're right. I came in August, and I represent a very explicit build strategy that the board wanted to articulate, and so I'm in the process of building that team that's going to go through the build. And as Jeff said, yes, we're on track. We're going through the environmental assessment process. We've got our first reserve now in hand with the pre-feasibility. The change flows through the project definition. I mean, and this is something I think we'll talk about, and I want to ask George and Jeff about when we have a general discussion. But we've taken a very deliberate view of kind of low capital intensity for the scope of our project. We've simplified it, and we're trying to tell a very simple story as the best way to move it forward. And that's in part due to what we think is the sweet spot for the market right now in terms of the advanced exploration sort of junior developer story. But we did raise money recently, and I think and it was oversubscribed. And I think all three of us are in that market sweet spot right now in the gold space, right? I think the producers aren't raising capital; they're happily producing gold at high gold prices, right? And there's not necessarily capital available for the kind of the grassroots startup exploration stories. There is, but I think the sweet spot right now is where we are, right? It's the developer market. It's the future mine development. It's the low capital intensity projects in good jurisdictions, and we're seeing generalists coming now into that space. I mean, we had, I think, 43 institutional investors in our book, mostly institutional, very little retail, mostly institutional in that financing. We did 34.5 million. Other financings that have happened recently have all been in that same space. I mean, we had a Cisco this week, again, advanced exploration kind of developer story with a big deal, also heavily oversubscribed by apparently. And it's a wide range of institutional investors looking for development stories, willing to take on what's previously been seen as a risk area of investment in the gold space. Picking the best names and piling on, right? And so that's very encouraging for all of us.
Yeah. I know all of you have been through some sort of build or development and even acquisition before. And George, you wrote a pretty interesting op-ed piece on LinkedIn a few months ago about basically needing to tackle whatever fork in the road may persist, whether it is continuing through development or even through an acquisition, and making sure all your cards are on the table so you know what the best hand it is to perform. I was just curious, like if you had questions now with Delamar, if you had questions for Matt. He did kind of mention something about going through and building the Valentine project, but one thing that stuck out was kind of a lower capex. I mean, is bigger better anymore, or more investors really want lower capex and would see that as a better opportunity?
Yeah, I don't know that bigger is better anymore. I think investors are just simply looking for credibility on something that a company like Marathon can reasonably build at a low cost. I think that's point number one. So don't try and knock it out of the park with the absolute biggest production profile that you can just to please one sort of potential buyer in the future. So they're looking at economics. Yeah, sure, it's great if you can scale something up in the future. But yeah, I think investors are looking at returns. To one of your sort of first points there, gosh, buy, sell or build. Far too many companies have made the mistake, I believe, in the past of rolling themselves out with a large production profile and saying, okay, here it is. It's going to be $500 million or more to build this thing. Come take me over. And the company can be waiting an awful long time for that to happen, and a lot of shareholder value can get eroded in the process, and fatigue can set in. So constantly maintaining that optionality of, okay, I don't need to be taken over. I can build this myself if I want to, because we've got the team and because it's low capital intensity. I think that's the way to go. And I think that's the hallmark, as a matter of fact, of all three
that's right.
projects on this call.
Yeah, and in fact, we learned a hard lesson on that basis, actually. And, we originally came out with a PEA back in 2018 that was really designed to we're all ex-Anglo Gold, and so we designed it as a project that Anglo Gold would go after. They own 19.9% of Corvus, and so we really put together a large-scale project with, almost 450 million of initial capex. And when we were lucky enough to be able to get Ron Largent to come in as our chairman, he looked at that and said, hey, look, there's a great project here at around 100 million capital that we can get in production, 150,000 ounces, a year kind of thing. Let's go forward and see what that project looks like. And that's been a very positive move. I mean, certainly we've taken a page out of the other guy's books here in trying to get that project. It's being put together as a pre-feas now, as can we get it going at a lower capital intensity? And, it's very interesting because the actual interest level in Corvus has gone up from a strategic basis, from a buyer basis, I would say, by doing that. And it's not like these big companies are ready to, hey, if you don't have a $500 million project, I'm not interested in it. Honestly, these guys, if they can find a build-as-you-go project that's, you get going for 100 million and you can grow it from there, hey, that's in everybody's playbook nowadays. I mean, they are all very conscious about capital these days. Their balance sheets are important to them. I think the days of, 2010 of, a Newmont going out and paying 2.7 billion for a Frontier are probably over. And they're going to be much more diligent about their balance sheet going forward in the future. So you need to provide these opportunities to them, I think, and certainly in these jurisdictions, I think where all of us work are pretty rural areas, and just building that social license, getting something going, getting it up, and starting to provide those jobs, which in most of these jurisdictions are the key element. You want to bring these guys along, you need one thing to really bring them along, and that's give them a job and pay them well for the job. And that's, that's what these early start, lower capital projects can do, I think, for these rural areas.
Yeah, I mean, we made a deliberate, when we'd started our pre-feasibility in September for the Valentine project, a Marathon, I mean, we made a specific decision that we were going to go after rate of return, maximize rate of return, minimize initial capital, and not give up on the attributes of scale, not give up on the big production profile and the big NAV, hold the line on those attributes. But we were going after rate of return and initial capital, right? Capital intensive. And we were interested, when we talk to investors, we talk about all the ratios, right? The ratio of NAV to CapEx, the ratio of the CapEx to our market cap. We don't want to present something that was a multiple of our market cap, and which has been the story of recent years with these bigger CapEx projects and smaller market caps, and you go down a private equity model, and I've been down that path of big financings with bells and whistles and everything cross-linked. We have an opportunity now to work with these lower capital intensity projects. All three of us have them. If you go on the website side, of all three of us, you'll see high rates of return in economic studies and low initial capitals. We've all gone the same way. It's the right way to go. We've all got good ratios. We've all got good ratio of NAV to CapEx and market cap to CapEx. And that's exactly what the market wants. And those are the projects that will get financed and built. And I agree 100% with what George said about, the strategy as a CEO of making your deposit as big as possible and putting out a study that's got the biggest possible production profile, and then sort of raising the flag up the flagpole and say, come on board, everybody, we're ready. You will sit around for a long time, right? Because all of the M&A, if that's your strategy, is to sell, all of the M&A that we've seen, most of it anyway, in the gold space has been in producing assets, right? In the most recent, Continental is an exception, right? But all of the other deals mostly is on producing assets. We're always compared, because of where we are, to Atlantic Gold, right? So Atlantic Gold was built in a low capital intensity strategy. It went through its ramp up, ironed out its bugs, had a year under its belt, and then transacted with St. Barbara, a mid-cap company from Australia that financed the acquisition, in the market in Australia at a high valuation, and continues to do well with the asset. That was a very successful deal for all concerned, and that is the environment we're now working in, that type of deal, that type of strategy, and investors are looking for that.
You brought up a really interesting point here, Matt, and as both you and Jeff were talking about this strategy, one thing sort of popped into my head. Mark Bristow, CEO of Barrick, came out with a statement this week. I don't know if you saw it or not, in which he said, the M&A is coming down the pipeline, and it is going to increase amongst the miners and the developers such as ourselves. However, the days of the big premium takeovers are over. And if you look at Integra Gold, for example, so that premium was 50% premium to market. I wonder if that has anything to do, or whether he was actually alluding to the fact that we, the three people or the three CEOs on this call, we've collectively made the decision not to upsize our builds and make them as big as possible and spend all that time and money on getting there, but just build something that's reasonable and with a reasonable set of economics that somebody else, yes, can scale up in the future. But by that virtue, maybe that means that none of us should be expecting, a knockout premium on our stock on M&A transactions. I just kind of wonder aloud. Love to hear your views on that.
What did you think of the Guyana Goldfields premium that ultimately was paid? That could have went the different, went a different route than Eric Bristow could have suggested it might.
Yeah, I think that one's starting from a different base.
Different place.
Yeah, different place. Maybe if you look at the evolution of their share price relative to the takeover value, they're coming off of an obvious bottom. So, maybe that premium was warranted at the end of the day.
M&A works, eventually with a willing buyer and a willing seller, right? I don't think this type of market that we have. To give the contrarian view to Bristow. in a market where companies like ourselves can readily tap equity and debt financing in a very fertile market, that's not the type of environment that lends itself to low premiums on M&A transactions and acquisitions, right?
Yeah,
Quite,
and
quite,
I
quite the
agree.
opposite.
Yeah, I totally agree, Matt. And I think that when you look at this and compare it to the last bull market, now you have an ability for companies like Marathon, Integra, and Corvus to actually finance a project at the scale that they're talking about doing. And that gives the shareholders a great advantage in these situations. I think the day of the cheap or low premium or no premium deal to backfill these production profiles that all these producers have. I mean, literally 5 years is a long production profile. And having worked for Anglo for many years and watched what that profile looks like in the out years, where you're having to bring in resources as opposed to reserves to the mine plan, and that if you are a diversified miner with multiple operations, some work, some don't, it's a constant need to replenish that profile. And these guys are going to have to go out into the market and get things. And these good jurisdictions, like Nevada, Idaho, Newfoundland, those places like that are going to be a premium. And from back in '09 and 10, there's about a third the amount of companies with good assets right now. So the pickings is much slimmer these days. And I agree, Matt, you're going to have to pay a premium to get these deals down the road, because we're prepared as companies to take these through the next step. And I mean, run your economics at $1,700 gold and see what they look like. I know we all do them at $1,400 or whatever, but that extra $200-300 an ounce is a hell of a premium right now. So I think we're all in a great space to do either or in my mind. And boy, if history's any track for the future, then I certainly see share prices going up pretty dramatically in over the next 2-3 years here with increasing gold price, and it's just going to get a hell of a lot more expensive for these guys to come after these things. We know it, they know it. It's I think you're going to see M&A in the second half of 2020 that definitely pick up.
Let me interrupt and kind of pick up on the same conversation, because I wanted to ask all three of you about the idea of cash flow. I know, Jeff, with your North Bullfrog, you are undergoing some testing to see if North Bullfrog might be able to turn into perhaps some sort of starter operation to create cash flow and bring in some money into to help develop the Mother Lode project as well. We've discussed that many times here on Mining Stock Daily. George, you are continuing to do more met testing. It sounds like potentially a lot of that stuff from Florida Mountain might easily be heap leachable and create some cash flow for Integra. Matt, I'm not quite sure about if there's potential for kind of some starter cash flow for Marathon with you're at right now. But can we have a conversation about cash flow and really continue to, I guess I don't know if I want to say de-risk, but that's kind of a simplified term, but actually create a more premium to a project down the road?
Yeah. So I'm no permitting specialist. I've never permitted a project in the U.S. Full stop. I've permitted projects elsewhere. I would say that, it would be great to get into a cash flow situation on something that's maybe smaller than what the PEA showed, and maybe scale up from there, which is great. However, I would believe that the permitting of a premise that looked like that, a smaller scale production scenario versus one that, say, what we defined in the PEA, would probably be, timeline would be similar to get there.
Okay.
So if you're going to permit a project, you might as well permit a bigger project, I guess, is kind of where I'm getting to on that from our perspective.
Yeah, I think from Corvus's perspective, when we look at what we call our phase one project, which is about 800,000 ounces recoverable, its footprint is small enough to maybe use an accelerated permitting path and just expand our current plan of operations we have at the project. But I think George is completely right. We'll probably go out and look at permitting the larger project at North Bullfrog just because you're doing the same work. And there's no sense in going out and doing it twice because essentially it's doing it twice for the same project. So, fortunately in the U.S., particularly in areas where you're on government land, things have gotten, I would say from my experience in permitting in say, the state of Nevada, things have definitely gotten better. So I think that we'll be able to move that permitting window forward. But cash flow is when we start looking at things. The thing that really got us with our phase one project is this thing looks like it's going to be at $1,400 gold, well over $400 million of cash flow after tax. And we're looking at being able to use this relatively small project that we can get up and running for about $100 million and have like a 4x on the initial capital, which is a really exceptional situation to be in my history of looking at developing these things. And that cash flow would be essential to making it happen down the road. Of course, the challenges are, little companies usually, they're in the past, historically, I think we've all talked about too big of ideas with too little capital, and it's one of those things that you definitely have to look at stage capital, and that capital you put in there has got to generate cash flow, so that you de-risk the larger project down the road. So I think that that cash flow is anything that looks like it can provide that critical cash flow in a short period of time is great. And then this market, I think we can probably raise enough cash and debt to adequately finance the development of these assets. Not just poor boy them and do them as cheaply as possible, but have that backstop of cash that, when inevitably problems come along, you can fix them down the road. I mean, historically, I've been through a couple build outs and both of them had, very difficult times while the build out was either going on or commissioning was going on, that you needed that extra cash. And if it wasn't for deep pocket major companies that were doing the build, it would have been very challenging for a small company. So yeah, it's, I think smaller's better, to be honest, and particularly if it can generate cash flow. So I think you're spot on, Trevor, that needs to be part of the mix there.
Yeah, we have the way we've designed the mine plan for the Valentine project has elements of this in it. So, we're the best grade in both deposits is close to the surface. So we're over 2 grams per ton in the first couple of years, head feed into the mill. So, rather than see that as a big bump in cash in the first couple of years, we've actually used that to contemplate starting with a smaller mill. So we're going to start with a 2.5 million ton a year mill, and then scale it up to 4 million tons when the grade drops down to the average life of mine grade. And so that allows us then, that kind of early cash flow potential in the form of higher grades allows us to actually contemplate a lower initial capital cost, right? So that's one of the ways where we've achieved capital intensities. We haven't gone for the dollars per se there. We've gone for the lower entry ticket price for getting started. And then we can do the mill expansion in year 3 to be available by year 4 out of cash flow at any price above about 1270, 1280 gold, right? So again, we're kind of, we're thinking about that in terms of capital intensity, not in terms of kind of, cash flow per se, right? But it's the same issue overall.
I want to kind of turn back into more drilling and exploration. And there's this idea that has been in the back of my head. And I think mainly it pertains to both George and Jeff, but I was thinking about, Jeff, with the latest drilling techniques and in that really deep hole that you came out with a couple of weeks ago. You're going through multiple layers of mineralization. It's not completely different. I'm obviously, comparing one project to the other is a lot like comparing apples to oranges. Don't get me wrong. I'm not oblivious to that, but it's very similar to what George has over at Delamar and multiple layers of mineralization. But I'm just kind of curious, George, when you looked at that news release about how Jeff and his team were pre-drilling, with RC and then going in and then going in deeper with the diamond core. I'm just curious if that gave you any sort of ideas of how you could approach drilling this summer and in the future at Delamar.
Yeah. First off, I'm hugely envious of Jeff's intercepts there, and I would have loved to have some of those in my back pocket. That technique of basically pre-collaring with RC and using a diamond tail does work for sure, and you end up saving a lot of money in the process of doing that. In terms of looking at the cost of drilling in the U.S., coming from Canada, where the cost of drilling was $120 a meter Canadian up in Val d'Or, and as soon as you cross the border, it's more than
double
times that. And the monopoly of drilling companies get together, and I believe, dare I say, use the word price fix. Nobody can explain to me why the cost of drilling in the U.S. is as high as it is. Maybe Jeff, you've got a view, but it doesn't make sense to me. But yeah, that's a great technique to save costs, and we're actually looking at it now.
Well, I'll tell you, it's a competition. I mean, it'd be great to have some of those diamond drill groups out of Quebec come down here or Newfoundland and do some drilling, but they haven't really translated down here. So you are stuck with sort of the guys that do it. And so you're paying twice as much as you do in Val d'Or, I'll tell you that. So, or Newfoundland. So it's a very important cost issue, but more importantly for us, it was a technical issue to actually get the holes down. And I think there are some big similarities between Delamar and where we are down near at Bullfrog, in the fact that they're both big epithermal systems. I mean, I was actually worked regional exploration around Delamar for NERCO back in the days in the 80s. And you got a big epithermal system where you go down and we think we're in a bit hotter part of the system, transitioning down into more of an intermediate sulfidation system. And so that's super encouraging in my mind. And literally the only way we could do it was get the pre-collars, start with PQ core, and be able to reduce twice, because the drilling sucks. We go through this volcanic package and then down into the Paleozoic carbonates. And once we go in there, the intrusive mineralization and alteration has been extensive, and we go into an oxide zone down there that has been hammered and very difficult to drill across. We're losing the holes with RC, couldn't get them down there. But the core drillers with enough experience have been able to maintain good recovery and get through this gushy ground that goes from soft to hard, soft to hard. And so that's the strategy we've used. But yeah, it's expensive, and you got to be hitting some pretty good grades down there to justify the drilling. I mean, we're pushing this deposit down to 500-600 meters deep, so it's definitely getting down there.
I actually wanted to bring in Matt here and talk, have him lead the way on discussion about financings. Seems how you just closed a nice financing for Marathon. We actually had to hold off on this conversation until that deal closed. So I'm happy that did close, so we continue with this. But obviously there seems to be a massive change in sentiment. We're seeing more brokered deals into this industry, which is nice. Which it seemed like there was a lot of the crypto and blockchain and cannabis industry was taking away a lot of those big bot deals in recent years, but it seems to be transitioning back into exploration and mineral resources now. I guess, Matt, can you give us a breakdown, not only what some challenges were with this recent financing that you might be able to share, but also what you may have learned through this process and could share with George and Jeff?
Yeah, well, it was a very good experience, that financing for us. We were quite disciplined about the size of it. You know, the use of proceeds is to do everything that we need to do to the end of 2021, when we hope and expect to be making a construction decision. So it's feasibility, it's the permitting, it's exploration as well, which is an important part for us. I mean, we want to do both side by side, but it's also detail engineering, it's early works, it's it's walking around money for project financing. It's long lead procurement items. So it's all the mechanical stuff that is important, which is done not just at this study stage, but also in the 6th month before you're putting shovels in the ground. So that gives us a treasury of about 54 million. We were quite disciplined about the size. There was a lot more available there. We could have done a much bigger deal, and we upsized it a relatively small amount. It ended up being 34 and a half, but there was room to upsize it more. But I think we wanted to just have the treasury to go through to that end of 2021 timeline, and then project financing will come next year. Look, I think in terms of how it went, look, it was bought deal. You know, it was we had 9 names on the term sheets. So there was very much a shout out to the analyst coverage that's been built up. You know, we were respectful of that. Institutional, very much weighted towards institutional investment, relatively small retail piece. As I said, a long list of institutional names. We were careful to have it. Obviously, we were prioritizing. I think one feature which we wanted to have with the brokers, and I think which is becoming a developing feature, is that we wanted to be involved in allocation. Right, we wanted, in a brokered bought deal, we wanted to have a say on who our shareholders were going to be, right? And there's a push and a pull there when you're dealing with a broker, because they've got their own relationships, right? So we were interested in the long-term investors, the bluer chip precious metals funds. We were pushing back on some of the hedge names that were out there, and so I think we were happy with how that went in that regard. And certainly the stock has performed on that basis, I think, since, right? We did a unit deal, right? Because we did a half warrant deal. There's always a debate on that issue, as George and Jeff will testify to. But we took the view, we had a 12-month warrant, and we're going to be project financing the build for this project. And we took the view, do we want this shareholder registry that we've had a hand in defining to be exercising those warrants on that time frame? And the answer was yes, we do. Right, we're going to be building this mine. On this schedule. We're going to be seeking project financing next year to do that, and these are the types of investors we'd like to be coming into the story at that price of that warrant. So if you take that view about a warrant, it's easy to do, especially when you're kind of having a say on the hedge fund type investor who is going to sell the stock to hold the warrant, right? That kind of play. So that package of direction, I think, worked well. The brokers were happy to work with us on that basis. And the financing came together very well. I think I've seen other financings happen at the same time, and we saw Sabina go to the market as, again, the Cisco mining, as I said earlier. Sabina's was quite different in that there was a lot of flow through there. So different kind of blends of pieces and different pricing scenario. A Cisco's was quite similar by the looks of it to ours. But I think that's the model again. But all of the names in our book, gold and precious metals investors, names that all of us would know, but also some generalists coming in, right? Some generalists coming in and putting their toe in the water on gold development stories, right? Looking for value in this gold sector they've been told about, and having the flexibility to do that. Somebody said, the markets were kind of very different a year ago. They were. You go to an investment conference and there'd be some panel on the stage, And they'd be talking about how all the equity that was available to the likes of us about 12 months ago was private equity or corporates, right? That was the theme. There wasn't any self-managed investment capital out there, right? The traditional fund manager that's got discretion and liquidity to buy a new issue or go into the market, you know, those guys were still selling down their positions and trying to fight off the redemptions, right? That's changed. Those people specifically do have liquidity. There is now money coming in. Very recently, there's been money coming into some of those funds. The generalists are appearing. And so that whole sector of the market, those managed funds in the precious and gold and precious metals sector, that's back to a degree, right? And you're seeing that in the amount of oversubscriptions happening in all of these deals in the last few weeks.
Yeah, what can I say about that? So a couple points. Obviously, the funds are starting to trickle and flow our way. Have we been offered money of late? Yes. As a junior mining company CEO, are the words "we don't need your money" hard to roll off of my lips? Extremely so. So we've had to make a conscious decision, despite being offered financings, that hey, let's get some traction first with this big exploration program that we have going on through the course of the summer, and see where that goes. And you know, we're good for the next 12 months, essentially, from a treasury perspective. So that's where we're at with that. One interesting thing that we found with it, you know, as a result of this, the pandemic and the quarantining measures, is doing these Zoom calls with funds that are now starting to show interest. And some of these funds are new, maybe names that we haven't heard of for a very long period of time. Interesting thing is, a number of these fund managers that we're talking to of late, you can tell that their last experience point with our sector was, you know, 2010, 2011, and then there was a hiatus, they left, and then now they're back, because the conversations they'll go like this. So we'll talk about heap leaching and you know, oxidation profiles and the different leach characteristics in the oxidation profiles at Delamar. And they'll say, well, can you explain that? I remember this and this about heap leaching and crushing fractions and clay, influences of clay. But that goes back to, you know, 2010, 2011. What's happened since then? So you can tell by the nature of the questions that you're getting from these fund managers that you know, they're coming back. And you know, that's a pretty interesting point. To Matt's point, I mean, just the number of institutions that you're seeing in the books now on these financings is quite incredible, quite impressive.
You know, that's interesting. You know, we raised money back in October, sort of the old market, and did a bought deal with BMO. And lucky enough to have mostly institutional investors come in. But, you know, it was a challenge after the financing to recover from, you know, post-financing hangover. And what it seems like I'm seeing now, well, Sabina might be a different example, but it seems like that hangover period has compressed itself, and that there is broader market buying that's coming in after, say, you know, the marathon financing and some of the others I've been watching. It's very interesting. After the marathon financing was announced, I got 3 different bankers that called me that very day and said they were leading the financing for marathon and that they could do one for us immediately if we wanted to. So I think we're seeing the typical banker, broker guys come around, and they see a paycheck out there for fees. And so they're hot to try and raise money with anything that looks like it has traction. And, you know, to Matt's point, you know, staying disciplined is a very difficult thing to do. And as George said, you know, as a junior guy, it's hard to turn down money when it's available. But, you know, I think we have to stay disciplined, particularly with the kind of strategy that these 3 companies have, that, you know, that we have to be careful not to get seduced by the the siren songs of the bankers that certainly want to, make that fee so they can make that payment on their Ferrari. So it's, I think it's something that's going to be challenging for everybody. If you got good use of proceeds, do it. Right now is probably not a bad time, but I love the idea of keeping that treasury that's solid for 12 months or 18 months, and let the shareholders benefit. Corvus has one definition of value, which is what my job is every day, is to create value for our shareholders, and that's share price. It's not market cap. It's not any of those other things. It's share price. People buy our stock to sell the stock at a higher price, and we as CEOs need to try and provide that deep down asset value that will support that ultimate move up in share price over, we have to be looking, at 1, 2, 3 years out, where we can see if this gold market's there, these values, that people are buying stock for today are going to be a huge discount for what they can sell it for in the future. So, we just keep moving forward on those things, I think.
Yeah, I spent some time in my career working out of the Agnico Eagle shop for, in the mid-2000s. And so I learned a lot from Sean Boyd. And Sean Boyd is, one of the best in the business at telling the story of Agnico Eagle. And he's been very influential in thinking about how I should act as a mining CEO. But he's all about, metrics per share, right? So when he stands up and does the Agnico Eagle Dog and Pony show, which he's, a master at, because he blends an understanding of each asset with a kind of a headline message. But his headline message is always, growth per share, dividends per share, ounces per share. Everything is a metric by share count, right? And that's a good yardstick, right? For all of us, right? That is ultimately what it's all about, right? And one thing I'll say about being disciplined with bankers, I absolutely agree with that. And one of the features, and I apologize to all the bankers out there that might be listening to this thing, one of the features of the COVID world is how many bankers there are out there sitting at home with their video conferencing board, and they've been told to go out there and generate business. It's true. And they're not traveling anymore, right? They're not entertaining clients. They're not getting together and having team meetings, so they've got so much more time on their hands, and the amount of downloads on the market. I mean, I'm not surprised you get calls from 3 people. They were leading our financing. I'm surprised it was just 3. I mean, they're all kind of like hyperactive right now because they got nothing else to do, and so their business hasn't been impacted at all. In fact, I think the bankers out there listening to this will probably agree they're busier than ever, right? Because of this dynamic, because they're all at home and they're all giving readouts on this deal or overviews on this sector, and the rest of us are sitting at home trying to manage our businesses, trying to get drill rigs going again in the field and thinking about protocols for, so we're going through all of that, right? George, sounds like you're doing well and you've already started and you've got a ramp up again in exploration. We're just, Newfoundland getting started on that. We hope to get going again very soon. So we're focused on that kind of stuff, the nuts and bolts. The bankers are all out there, looking for business, right? And we're getting the inbounds. That isn't why we financed, by the way. We had use of proceeds to the end of 2021. So, but nevertheless, that dynamic is happening for sure.
Gentlemen, we only have a few minutes left. I don't want to go longer than the hour that we originally allocated. But I do want to make sure you are given a quick opportunity to ask questions from each other instead of me asking all the questions. So go ahead and ask away if anything comes to mind.
Well, I have one question for both George and Matt is, Matt alluded to the generalists coming in. To me, that is the important catalyst. When these guys start to come to the gold sector, it's important. So have you guys, it sounds like Matt has seen genuine generalist interest, not just the specialists in the gold sector. George, have you seen interest in the stock? I know you watch it pretty closely with Integra. So do you see that kind of buying, you think, coming out of the market? I know it's hard to tell, but.
It is hard to tell. We've seen interest in our stock from, and I'm kind of loath to call them generalists, but we've seen interest in our stock from funds that used to play in the resource space maybe 7-8 years ago, left the space and are now coming back. And I don't know if I would call them generalists or not. They're certainly not specialists or resource specific funds. So we are seeing that. Yeah.
That's great.
Yeah, and you can always tell this, we're doing a lot of marketing, from home, a lot of online virtual marketing, several meetings a day usually. And, when you start having a marketing meeting with a fund that, some young fund manager who is asking very simple questions about the techniques of mining and the resource definition. And, when you're into that type of meeting, that the market has changed, right?
Yeah.
In the down cycles of the market, it's the guys who've been around forever and they've still got their fund going and they know everything about your business and all the questions to ask. When you start having a more generalist, but a sort of higher level, sort of nuts and bolts type marketing meeting, the market has turned.
I have a question for you guys. So we've seen a number of transactions of late, M&A transactions, which in my mind anyway, are clearly designed to create larger market capitalization size companies in order to attract those funds and generalists maybe that can only start playing in sort of larger cap stocks. I mean, it's clear they're trying to kind of bolt things on to get to a size market capitalization where they'll attract the bigger funds. So I guess the question to both of you, with sort of essentially, and we're in the same boat, single asset companies, really. Any temptation to look at other things right now in this market to bolt on to make yourselves look big? Jeff, maybe we'll start with you.
I think that's always an interesting idea. One of the things that although that I've seen is we're seeing at Corvus, and you guys probably have seen it as well, is that the mid-tier market is becoming much more active at looking at opportunities like us. I think good jurisdictions, it's, if you're going to move out, and I would just use, say, Australia, but if we're going to move out of their home country, where do they want to go? Do they want to go to the Congo, or do they want to come to North America? And I think we're seeing a lot more activity, at least from our standpoint, of groups like that particularly if we can provide them with these kind of assets that are certainly within their scope to go forward with. So I think that, I haven't really thought about trying to put together two junior developers. To me, that seems like that you're doubling your potential risk by doing that. But, there is probably a reasonable way to look forward, particularly for our shareholders, at not looking at necessarily the biggest guys, but maybe guys that offer some real advantage in the market. And for the shareholders to you're adding your asset, and it's not some little tiny piece of a larger puzzle, but you're adding your asset as a material piece to a group that's a talented mining group. So from my perspective, that's things that I've been looking at. And of course, right now, and I think Matt may have brought it up, exploration deals are actually still pretty cheap right now. These guys are still suffering. They haven't got the joy necessarily. So, there's going to be opportunity in those areas as well, I think.
Yeah, I was asked that question at a National Bank lunch during the winter, and Sabina, Bruce McLeod, and John Pazinski of Cisco were on the stage as well. And I think there's a lot of rationale for junior producers at this moment to come together and bulk up, right? Junior developers, the rationale isn't there for that ever, I think, market irrespective. because investors can, if they, they're very asset specific for a junior developer, right? So they like asset A, they'll invest in company with asset A. They don't like asset B, they want to invest in that one. So there isn't, unless there's a specific kind of rationale, there's cash flow that can be taken from one asset and applied to another asset, something like that, or a specific localized synergy argument for it. I don't think the market wants to see junior developers merged for the sake of creating a bigger development story. There has to be something else. But I'm going to turn that question back at you, George. And what's your view on that question that you asked us?
Yeah, it's funny. I mean, we, the CEOs, we try and respond to the needs of our shareholders, and gosh, I've got to say the consensus amongst our shareholders in terms of feedback that we get is 50-50. In other words, Matt, exactly what you just said. Hey, don't go out and acquire another project because it just becomes a different burn rate while you're trying to develop one, right? You don't need two mouths to feed. And then you'll get the other type of shareholder who will say, wow, one asset company, if that fails, you guys are screwed. And I'm, as a shareholder, and I'm in deep trouble as well. So it seems that we get mixed messages, a lot of mixed messages on that front. In terms of bolting things on, rather than say go too far afield of where we're at in southwestern Idaho, we've been kind of bolting on bits and pieces of the existing district, really turning it into a district play as opposed to two disparate low sulfidation epithermal deposits, and we kind of preferred doing that rather than jumping out of the state or going to a completely new district to look at something different for now.
Yep.
Well, we should probably wrap it up because we are coming down on the hour. And I'm sure we could continue a conversation for a few other hours. So maybe we'll do a part 2 installment here in the future and see how maybe a roundup to see as we get more drilling results from all three of you and seeing how the processes had went and other challenges and successes along the road. So I really appreciate all of your time, and thank you so much for it and for joining us.
Thanks, Trevor.
Thanks, Trevor.
All right, that's Matt Manson, CEO of Marathon Gold, Jeff Pontius, CEO of Corvus Gold, and George Salamis, CEO of Integra Resources. And this is Mining Stock Daily. Thank you so much for tuning in. We will talk to you again down the road.